Make sure that you don't need no mention. Yeah, you're my only intention. Already passed you, now I'm beautiful. But everywhere, no one about, no one feels good. Second to none, you got the upper hand now. Don't need this much, no, you're the friend now. You're my rock, my Colorado. Got that ring, just like Toronto. Love you now, like I'm off tomorrow. So I feel, act like you know that you are. It's a perfect, you don't need no filter. Gorgeous, like I'm drop dead, you a killer. Shower you with all my attention. Yeah, these are my only intentions. Stay in the kitchen cooking up at your own bread. Whipping hearts full of equity overnight. That's the make sure that you don't need no man. Yeah, these are my only intentions. No pretending, you don't need mention. I don't feel gold, they don't wanna be independent. You can tell them the market business, we in our feelings. It's 50-50%. What you need, let us both admit it. Both, when we both listen. Both, it's a blessing. Cause we both get it. Both, you the best thing. And I don't need a witness. I'ma find me a ring, praise, perfect fit. You don't need no filter. Just make them drop dead. You a killer. Shower you with all my attention. I will give these my only intention. Cooking up what's wrong with me. Heart full of equity overnight. Make sure that you don't need no right back on your feet, so you can take advantage of me. Tell me how to treat you, you're not there. It's so hard, go away from me. You don't want to know it's out there. Ain't this guy ever gonna lose me? Thinking you could live, come on, thinking you could live, come on, baby, I'm on.
Good morning. Welcome to Money Talk. We'll be getting started shortly. Welcome on, Cherie. Welcome on, Jaime. Good to see you guys. Welcome on, R. I'm not sure who that is, but I see an R there. Welcome on. I see a call in. Last 3 digits, 775. Welcome on. Welcome on. Welcome on, Tamika. Welcome on. Welcome on, Beverly. Welcome on. Time to get started. Welcome on the Money Talk, guys. Welcome on, welcome on. All right, welcome on. Happy Tuesday, everybody. I hope everybody's having a fantastic day. It's a beautiful day today for us to continue to learn and put ourselves in positions to continue, expand our knowledge and definitely expand upon our understanding, especially when it's pertaining to finance and learning how to keep winning the money game. So like I said, today we're going to pick up where we left off, which is actually on insurance. And today we're going to talk about all kind of insurance, so that way we have a better understanding of some of them, okay? So maybe you'll see on your screen also upcoming events that'll be taking place this Saturday, so just mark your calendar and definitely come on by. We always welcome you guys to come and learn, all right? So you can probably take a screenshot of that, post it on your social media, invite a friend and tell a friend. So guys, let's jump right into it. Term insurance, right? You see, the thing about term insurance is that we got to understand what it's all about. So right here in the Saving the Future book, it talks about it. It says that the following discussion, while being general in nature, is that they provide a good foundation of understanding of how insurance works. The concept applied in the U.S. and Canada. Now, let me say this, and I'm going to say this one time. All insurance is term insurance. Yep, I just said that. Boom, just dropped the bomb on you. All insurance is term insurance. Now, you got to stick around to find out why I said that. All right, so insurance policies are based on what is known as the cost of insurance, COI. So if you ever see that in your policy, COI stands for the cost of insurance. You see, you just got to understand that all life insurance, the cost goes up every year because the risk of dying get higher because you get closer and you get older, and the older you get, the closer you get to dying. So the cost of insurance goes up every year for all insurance. It is also based on your health. For example, whether you smoke or not affects the rate, which means the cost of insurance. And if you're a female, your rate is lower due to having better life expectancy. Yes. So females, your rate is way cheaper due to the fact that they say that you will live up until around age 88, while for most men it's around 79. Okay? So some refer to it as temporary insurance because it has a term or a set period of coverage. And you have the different kind of terms. Generally, there's three kind of term insurance, guys. All right. The first one that most of you probably own is something called annual renewable terms. And pretty much there comes in different types. There's annual renewable term that goes up every year. There's annual renewable term that goes up every 5 years or every 10 years or every 10 years, right? So there are also things called level term. All right. There's something called level term. Level term meaning that it's a 5-year, 10-year, 20-year, or a 30-year term. So this amount of the amount that is paid for the coverage is the same or it's level for the term. For example, 5 years. Okay. However, at the end of each term, the cost increases, typically much higher than what the annual renewable term is. You see, the insurance company average the cost of insurance for the term. For example, in the above case, the cost of insurance will goes up from $1 at age 35 to $1.50 at the age 39 because the 5-year term was over. So where you start off with the term and the term is over, the cost will go up every year. So so that may mean that they will charge you $125 for another 5 years of the term as well. So you got to keep that in mind, all right? So now there's something called decrease in term. A lot of people don't own this unless you have it for a mortgage. So normally sold as mortgage life insurance, the premium cost will not increase during the term of the mortgage. Also, the death benefit will pay off the balance of the mortgage. Thus, if something was to happen to you, the house will be paid off for the surviving spouse. Sounds good, right? So that's something that you can keep in mind. So mortgage life insurance is still term life. However, since the balance of the loan will decrease every year, the benefits will decrease accordingly as well. Thus, you are buying a decrease in term. Make sure you look at the cost. Quite often, you can even get a better rate with a level term, and the benefits will actually remain consistent and not decrease during that term as well. So that's something to keep in mind, okay? Now, also, there's something called return of premium term, all right, known as ROP, return of premium term. Now, this policy will return the premium for the coverage if the insured survived the policy term. So meaning, for example, let's say that you pay $1,000 for a $500,000 coverage in 20 years, right? So the return of the premium policy after 20 years, if nothing didn't happen to your life, then you will get that $20,000 back paid to you. So this type of term may cost you more and may have taxable implication. So make sure that the cost to make to make good decisions. So pretty much mean that even though they return the money back to you, just know that you may have to pay taxes on that, maybe tax as ordinary income because you no longer have that tax shelter to protect the money. As far as the life insurance, you don't have it to protect the money, so the money's now liable to paying taxes. So term insurance is a simple insurance. You pay the insurance company. If you die, they pay the benefits to your family, not you. If you don't die, they don't pay, and you lose the premium money. It's just like car insurance, guys. All right? You pay for the car insurance. If nothing happens to the car, that money is not going to be returned back to you. All right? So is your term renewable? You got to be aware of that some term policies are not renewable terms. And you also got to know that, yes, many term policies are renewable at the same time. It means that you are guaranteed to renew the term for the rest of your life, regardless of your health condition. But here's what you got to realize that. It doesn't mean that the premium that you're paying, it will always be the same as well. So keep that in mind. But with non-renewable term, you may not be able to renew unless you have good health. Of course, non-renewable term is all usually cheaper than renewable term as well. So keep that in mind. So is your term convertible? Now, convertible insurance policy allow insurers to convert another policy, usually the term, to a permanent life, regardless of the insured health. So most often, this conversion privilege applies to employees who also have group insurance. And when they end their employment, the conversion period typically at 31 days after termination. However, many people fail to follow through as well with that. And that's why some of them have the confusion and how to keep on winning the money game doing that. Now, guys, here's something that I'm also going to share with you. Did you know that when you think about a whole life, right, or anything that's past is better than a term insurance, what you're really saying is that term, right, permanent life, all it means is that term plus cash. Permanent life insurance is just term plus cash value. That's all it is. Permanent life is term plus cash value. Now, this is also called cash value life insurance. And there are different types of permanent life, right? So the first one we're going to talk about is whole life. So whole life is one of the most original version of permanent life insurance. It's pretty much, the original, it's the Godfather, it's the Nokia of cell phones, okay? So, it's pretty much an old version of life insurance. Instead of paying just for the cost of insurance, you pay a higher premium. The difference between the cost of insurance and the premium goes into the cash value. Whole life policy gives you a guaranteed rate of interest. Some insurance companies may provide dividends, but dividends are not guaranteed. So keep that in mind as well. Now, the cash value compound with interest built up in the early years will pay for the higher cost of insurance in the later years. So the policy can last the whole lifetime. Okay? So whole life is typically not flexible. The premium is fixed. The interest is guaranteed. And the death benefit is also fixed. Since insurance companies have to guarantee you the interest for the whole life, they tend to give a conservative rate, anywhere from 2 to 3%. You're lucky if you get a 5% guaranteed interest. As a result, the cash buildup can be slow. it should be noted that all that these type of policies may have surrender charges as well. Fees that are associated with canceling the policy in the early years. These are long-term, whole life products. Keep that in mind. All right. So just like I promised yesterday, I was going to break down term, where we talk about buy term, invest the difference. And many of us have heard this logic, right? It was a good logic that was actually created by a gentleman named A.L. Williams. And A.L. Williams then converted that and sold his distribution force team to Primerica. And then Primerica still adapt this and still believe in this logic. But let me give you some understanding, because remember what I said yesterday? If you understand taxes, you will know where to put your own money. You, not me, you will know where to put your own money. So let me break it down what buy term invest the difference mean, and you let me know. I want you guys to then get ready, right? So go to your participant section, and when I ask the question, do you like buy term and invest the difference? I want you to hit a yes or a no, okay? So I'm going to go through it now. I'm going to break it down. So buy term, invest the difference. Many people say, why bother with term, with cash value, life insurance, especially whole life, when you can use a strategy such as buy term and invest the difference? A question, why should you pay, for example, $1,000 a year for a whole life when you could just pay $200 for a term insurance for the same coverage? So you can invest the difference of the $800 into another investment vehicle, such as a mutual fund, to get a better potential rate of return. Let's stop. If you understand taxes, you would know where to put your own money. So if you buy term insurance, let's say that you buy a 30-year term. You buy a 30-year term, you're 20 years old. You invest the difference into a mutual fund. Where is a mutual fund on your tax bracket? It is in the tax now, which means taxable. Means that any earnings inside of that vehicle is subject to pay tax. Any dividends that is taken out of this vehicle subject to paying tax. So my question to you is, do you still, or do you believe that buying a term insurance, if you're 20 years old and you turn 50 years old, and you know you have to renew that term, it's going to be a lot more expensive when you're 50 versus when you had it when you bought it in your 20s. And then you invest in the difference to where you're going to be taxed every time the money make money, and you're going to be taxed every time you take a dividend from the investment. Now, is buy term invest the difference a good deal? Yes or no? I see one say no. I see Jaime say no. Anybody else think buy term invest the difference is a good deal? Victor Gordon said no. Sheila Forbes said no. Cherie said no. Swan say no. Tamika say no. All right. So, with that said, do you see why education is important? Now, one may say, well, Keyon, what about if they put it in the IRA? Okay. Where's the IRA land on the tax bracket? It's in the tax-related vehicle. Now you got to wait till 59.5 to touch your money. If you don't start taking the money by 70.5, you're going to lose 50% of it. And yes, they're going to tax his ordinary income on every withdrawal. Well, Keyon, what about if you use a Roth IRA? Isn't it a Roth IRA good? It's a tax advantage vehicle. Okay, let's look at the rule again. You still can't touch the money until 59.5. You may get tax-free withdrawal, but there's a limit to how much you can put inside of it. And yes, all of the vehicles I just talked about is still tied to the market performance. So if the market does good, you make money. If the market does bad, you lose money. Didn't see that one coming, did you? Let's continue. Guys, you see, In order for this theory of buying term investor difference to work, guys, number one, you must have the discipline to be consistent in investing the difference. If not, you may just end up buying term but spending the difference. With uncertainty about the economy and ever-changing job market, consistency can be challenged. Number two, you must know how to invest the difference. Other investments may be able to give you a better rate of return, but they may also sink your nest egg. In either case, if your investment having performed well at the end of your term and the cost of insurance substantially increases, you may have lost your surplus money, or even worse, you may no longer be able to afford or continue the insurance coverage. So you got to consider all your options and find the ones that are suitable for your financial foundation. And that's the reason why it's incredible to know, it's important for you to know how to break down these terminology these companies use. How many of you guys are happy that Money Talk is here? All right? Yes or no? How many of you guys are happy? You see, guys, that's why I want you guys to come and learn, so you could come and empower yourself, so you can protect your family. Because these people will sell you these things and sleep good at night. They will do this to you and your family and sleep good at night. They lose no sweat telling your family this is a good deal. Let's talk about the other ones. I'm going to run through these very quickly. There's something called a universal life. Universal life, the difference between universal life and whole life is that it's very flexible. It means that you could pay more one month or less the next. It also means that you can even skip a few months payments as long as you have enough money inside of it to pay for the cost of insurance. You can also adjust the death benefit as well. There's something called index universal life. I want you to pay attention to the letter in front of the universal. Universal life comes in many forms. There's a VUL, there's an IUL, and there's many of them, okay? So the IUL, Index Universal Life, all it means is that Index Universal Life is a very new product, but it's a fast-growing product in the financial industry. Guys, since it's a universal life, it gives you all the flexibility that we just talked about a universal life. The important part about it is that, you know, the cash value is based on a certain index, like an S&P 500, the NASDAQ, the global index, the Euro stocks, Hang Seng, and even Dow Jones in some of them. Guys, the investor, here's the cool thing about it. Unlike your IRAs, your 401ks, and all these things that's in the market, your IUL is not in the market, but it's credited by the index, meaning that they're credited by the market performance. It also gives you a cap, means that if there's an earning potential as far as it will cap out at 15% for some of them, meaning that the market does 20%, you will get 15%. It means that the market does 10%, you will get 10%. If the market does 1%, you get 1%. But if the market goes down negative 1%, you will get a positive 0.75%. Meaning, if the market goes below zero, you will still walk away as a hero. That means you don't lose any money. It means you don't lose any money. How many of you knew that about your IUL? There's a cap, meaning that the market does 20%, you get 15. If the market does 10, you get 10. That's the part that you can't guarantee. We don't know what the market will do. But we can guarantee you that every time the market does a negative, you're getting a positive 0.75%. Can any 401k, IRA, SEP IRA, annuities, your pension, anything do that? Can you name anything that you could think of off the top of your head right now that could do that? I'll wait. Then people want to tell me that I don't know what I'm talking about. What? Tell me where else I could put my money and get that done for me. And then when I need it, I get tax advantages. I get tax-free withdrawal. Oh, I'm not going to rush it. I'm not going to rush it. I'm going to break it all down. Guys, which one should you choose? That's the thing that people always ask me, Keyon, which one should I choose? Well, guys, let me break it down. If you're paying for the cost of insurance, guys, all you got to understand that you're buying term insurance. If the cash value is fixed, just know that you're owning a whole life. If the interest is market sensitive and flexible, it's a universal life. If the cash value is tied to the index, it's a index universal life. So when you're buying these things and you want to know which one you should own, guys, it all comes down to what you're looking for. It's all about the dime method. Once you run the dime method, you just got to know, is this suitable and is it affordable for me? That's what it all comes down to. Is it suitable or is it affordable for me? We could just sum it all up and just say that all insurance is term insurance. Like I said, because everything is every insurance is tied to what is the cost of insurance. The cost of the term always goes up. There is no free lunch, guys. You have to pay for it. In other words, all insurance is either term or term plus cash. The cost of insurance goes up as you get older, and you must pay for the term directly, right? Or you must have enough money in the cash value to pay for it. So what are some other types of life insurance? Right? What are some other types of life insurance? There's something called an accidental death benefit, guys. This insurance can be a standalone option, but it's often added to an existing life insurance policy as well, also known as a double indemnity coverage. It covers all the accident-related death, unlike regular life insurance, which cover all your death as well. How about joint life insurance? Joint life insurance generally cover two people, typically a married couple. There's two types of joint policy, typically available for the first to die or second to die policy. The second to die policy does not pay the benefits until the death of the last surviving spouse. The first to die policy only pays out when the first person passed away. All right, these are things that you must know. How about the key person insurance? It's simply a life insurance policy on the key person of the business. Normally, it applies to the owner of the or the key person. People who are very important to the business. If something were to happen to them, the company or the business may not survive. So when you do a key person insurance, you could list your LLC or your company's information as the owner of the policy, and then that's a good tax write-off for you as well. How about executive bonus life? This is a life insurance policy that is offered to an executive in the company. The company pays for the premium and can deduct the tax-exempt contribution. The executive receive the benefits. You see, with executive bonus policies, the cash value, the executive can take out a loan against the policy. However, he or she must claim the premium as regular income tax. And in the event as executive passes away, the family will receive the benefit. There's also something called final expense insurance. Final expense insurance, also referred to funeral expense insurance. This insurance is usually used to pay for the cost of funeral. This gives some peace of mind to the final days without increasing an additional financial burden to the loved ones. For people who may not qualify for regular life insurance, this product is handy due to the simplified and easy underwriting. In many cases, people who have medical issues may still have a chance to qualify because they don't have to go through a medical exam. Some of them don't even ask any questions. You just fill out the application. How about living benefits of life insurance, guys? Do you know what is the living benefit of life insurance? These are also known as accelerated death benefits, are features where the life insurance company pay in advance a portion of the policy's death benefit to the insurer to pay for the care or treatment. If the insurer dies, the balance of the death benefit will be what is paid to the beneficiary. So what it means is that if you was to ever have any problems, if you had any problems, meaning that like if you had a terminal illness or a critical illness or critical illness, they would advance a portion of the death benefit out to your family to help take care of your care, right? Did you know that? There's even some term insurance policies that could also give you living benefits as well. How about the fact that there's tax advantage of life insurance? Did you know that underneath the Internal Revenue Service, which is the IRS guidelines, insurance policies receive favorable tax advantages, guys? Did you know that you could get a tax-free death benefit, which means that should the insurer die, the entire death benefit, including the cash value, is income tax-free to your beneficiaries? Did you also know that you get a tax-free earnings, which tax-deferred earnings, which means you do not pay taxes on the gains in your policy? Another question, can your 401k, your IRAs, your pensions, your annuities, your mutual funds, can they not get taxed on the gains in those policies? Yes or no? Right? Life insurance does that though. Life insurance, get tax deferred earnings. You do not pay tax on the gains in the policy. Can your 401k do that? And then to add some more great things, did you know you can get tax-free withdrawals? Did you know that you can get tax-free loans? Once again, do your 401k allow you to get a tax-free loan? Exactly. I could wait all day. See, guys, as long as you stay within the IRS guideline, the withdrawals and loans can be taken out without federal income tax liabilities. That's why it's important for you to learn how life insurance works, so that way you could be in a better position to keep winning the money game. So I'm excited. I'm excited to tell you that tomorrow we're going to cover some really good topics. Tomorrow we're going to talk about understanding annuities. All right, we're going to talk about understanding annuities. So today what I want to do is that I want to open up the call for anyone that would like to share or share the takeaway from today. Just press the yes button, right? If you'd like to share, you can just press the yes button, and I'd love to hear from you guys. All right, so while you press yes, so keep the yes up if you'd like to share, so I can call you guys, and I'll definitely ask you to share. All right, so first up we have Cherie. Cherie, you're live. Good morning.
Hey, good morning, everyone. What a wonderful Monday Talks call today, Keyon. I mean, when I say that you're so on time with your information, just yesterday I was actually at the store and I overheard someone breaking down term life and whole life over the phone to someone, and I was hours away and I was just listening to them break it down. But I was like, is he not going to talk about universal life? Is he not going to talk about all the different insurances? Because he just seemed to be talking about term life and term life and whole life to the person that he was speaking to. But I was in business, but I just realized that if people don't get the information or don't have someone that cares to give them the information, they'll just walk away feeling that they're good, they're protected. So I really, really appreciate this Money Talk calls, because you are giving the information, you are educating, and you are empowering. So thank you so much for the Money Talk calls today, Keyon.
You're still muted, Keyon.
You're muted, Keyon.
I'm over here talking up a storm. I was over here saying that there's people that's only going to talk to you about things that they can only offer to you. Sometimes their company only allows them to sell whole life or just sometimes term, and they only talk to you about it. They're going to talk to you about everything. That's why I love what we are, because our campaign, we're not biased. We can offer anything to you, but we're going to educate you about all of them at least, so that way you have a better chance to know what is best fit for you. But I think we see Jaime that wanted to share as well. If you definitely want to share, please hit that yes or raise your hand so we can call you next. Jaime, you're live.
Hello, good morning, everybody. Thanks again for the money talks, Keyon. Just one quick question. Three different types of terms: annual renewable term, level term, and what was the third one?
So the three types is that you got annual renewable term, right? An annual renewable term come in where it renews every year, or it's a 5 year, or it's a 10 year, a 20 year, a 30 year, right? So annual renewable term, it comes in the form of a level, and then you also have what's known as a decreasing term, and then you also have, and this decreasing term is mostly used for mortgage, and then you also have what is known as a return of premium term, okay? But there's also one more that they don't talk about much because most of the time people don't use them. There's also something called increasing term as well, okay? And all increasing term means that the death benefit will go up every year, which will then increase the premium every year. Anybody else like to share or ask a question? We have Miss Victoria Gordon. Good morning. You'd have to mute.
All right. Good morning.
Good morning.
Good
How you
morning.
doing?
I'm doing wonderful. I just want to make sure I get this completely correct. So, really, to know what type of insurance you need to know that dime method.
Correct. That will tell you how much you actually need.
Okay.
Once
How
you know
much?
what you need, then we shop around and see which one will be suitable and affordable for you based on what you need.
Okay. Thanks.
Are you welcome? And it is one thing I want to make clear. I'm not against term insurance, right? And I want everybody to think that I'm, anti-term, because I tell you, I have term insurance, but I buy term insurance for the different reasons. Like for me, I have 5 kids, and I need to have at least $5 million in protection while they're young, right? So most of the time I look at it and say, man, when I first started, at the time I had Kareem and Casey and Kiki at the time. So I needed like a $3 million policy. So I couldn't just put in place $3 million a face amount of money. I wasn't making that type of money back then. So I did get $1 million term policy. And then I had like a $300,000 regular GIUL at the time. And then I was about $1.3 million in coverage at the time. And then over time, I got more, right? And then, so that time I could have worked with what my pocket could have. And then I started learning about the IUL, and I learned about the base rider, where I could add on a term rider inside of the base rider and get something permanent with a term insurance rider inside of it as well. And then I was able to increase my amount that is worth. So yeah, every year I try to fight to increase my value, because once again, if something happens to me, I want to make sure that each one of my kids get $1 million each, right? So that way they never have to fend for anything. So yeah, that's my goal. My goal is fighting to get to that $5 million mark. But I don't want to just have it in term insurance, right? I want to have them in something permanently, so that way that cash value can keep building up inside of there as well. So I'm not against term, but if it's affordable and it's suitable for you, then it makes sense. But if I could get you something permanently with a base rider inside of it, as a term rider inside of it, I will look that direction as well. All right, so I just want to make you guys know that. But I don't think it should be pushed as the only thing and then telling you to invest the difference. Because if you look at an indexed universal life, it is like buying term and invest in the difference. It's just like you don't have to worry about your term running out in 30 years. Your term just goes a little bit longer to age 121. And then you invest in the difference because your money is credited by an index. That is invested, right? It may not be an investment vehicle, but it's invested. It's credited by the index, right? So you just got to look at what buy term invest difference. And that's why when a lot of people, I had a conversation. I'll share something with you guys. When I had a conversation once with someone who's an RVP, which is accumulated as someone as a top performing person over in that company. And I said to him, he said, buy term invest the difference. I said, great. My clients buy term invest the difference too. He said, how is that? I said, well, they buy term invest the difference because everything is about the cost of insurance, isn't it? Your cost of insurance as a term policy is just the same thing as if they were to buy a policy that is here with an index universal life. He said, how is that? I said, well, let's look at the cost of insurance. When I broke down the cost of insurance and I showed him what was the policy value versus what was the cost of insurance after it's taken out, I divided by 12. He looked at me and I said, run your term policy. He ran his term policy. He was a little cheaper. And I said, great. Now look at mine for the consecutive years up until age 121. My policy value grew to where the premium that they put in versus the policy value grew more than what they started to put in. So can your term insurance and you're investing the difference do that? And now when you invest the difference, how do your clients get their money? And they'll use the IRA. I say, great. Now can your IRA guarantee them to give them a cap, or better yet, can you guarantee to give them a floor? Let's say that you can earn them 100%. Now when the market goes 100% below, what's the protection for their money? Every time I show them up, right? I tell people, get any one of your Primerica agents. Get the biggest guy over there. Get A.L. Williams for all I care. Let's have a discussion. Because that very same Primerica agent, he got so mad, he was like, well, cash value, he went back to just being ignorant. I was like, all right, man. I think I have a video of it. I have to look for it. I'll probably find the video. I'll see if I can find the video. It's on my Facebook where we did a live. And man, let me tell you, he wasn't ready. He was like the Kevin Hart face. He wasn't ready. He didn't know that he was coming up against Mr. Finance. All right? I break it down, guys. I don't care. Get your financial advisor. Get him on here. Let's have a money talk. Let's have a money talk. Right? And I reminded that I never went to school. I never went to college. I didn't go to all those fancy things you did. But you know who taught me? World System Builders taught me. World System Builders, WFG, is the greatest college you can go to if you want to learn about finance. So, you want to learn about some finance? Come to our college. You can learn and earn here. That's what they did to this 23 years old. All right? But anything else, guys? Anybody else like to share before I close out? All good? All right. So today we're going to close out just a little bit different. You know, normally we'll shout, but today I want you guys to help me sing happy birthday to Tamika. Today's her birthday. Turned 21 today. All right. So let's all unmute and let's all wish Tamika a happy birthday. On the count of 3, let's sing happy birthday. All right. 1, 2, 3. Let's sing. Happy
birthday to you.
Happy
birthday to you. Happy birthday,
Tamika.
Happy birthday to you.
What?
Woo! Happy birthday!
Happy birthday, Tamika.
Happy birthday.
All right, guys. You have a blessed day. Tamika, happy birthday, guys. And let's all have a beautiful day.
You.
You too.
You too.
All right, guys. See you guys tomorrow.
Okay.
Bye-bye.
Bye.